Hi everybody, I am Dr. A. Nagalakshmi, Assistant Professor, Department of BCom Finance, Dr. S.N.S. Rajalakshmi College of Arts and Science, Coimbatore. I am here to present the PPT on corporate accounting. Now we are going to see what is meant by share capital. Owners of the companies are called shareholders. Founding members are also known as subscribers. All shareholders are sometimes referred to as members. Shares in a public company can be purchased when the company issues a prospectus. Shares in a public company can also be traded on a stock exchange. So, what is meant by share capital means the total volume of capital raised due to the issue of shares is said to be the share capital. So the shareholders are said to be the shareholders are said to be the owners of the company. Equity shareholders are termed as owners of the company. Issue price of shares, maximization of shareholders' wealth. So, effect on the market price of existing shares. Requirement to sell a desired volume of shares. Expectation of future profits and dividends to service the new shares. Whether ask listing is proposed or already exist. Usage of an underwriter. So issue price of shares. When a company is going to make the issue of shares to the general public, they have to quote a value called as face value. Uncalled and paid up share capital. Shares can be issued to be paid in full or issued partly paid with the balance paid at a future dates. So when a company is issuing the shares, they will be, if the face value of share is 10 rupees, they will be making a issue for 10 rupees. If for example, X is a person who is going to apply for the shares of that particular company and he is applying for 100 shares and all the 100 shares allotted to him means he has to pay 10 rupees for one share. So 100 into 10,000 rupees he has to pay to buy the shares. Amount to be paid at future dates referred to as calls. Next example, say the same type of company, the same company is making the issue of shares at 10 rupees. They are asking 2 rupees for 2 rupees at the time of application, 2 rupees at the time of allotment of shares, 2 rupees first call, 2 rupees second call and 2 rupees final call. That means they are splitting the amount into various stages. Okay, for example, if a company is going to make 10 lakh shares, issue of 10 lakh shares at a rate of 10 rupees each. First, at the time of application, they are asking the applicant to pay rupees 2 for application. For one application, he has to pay 2 rupees. If he is subscribing, if he is asking for 1000 shares, 1000 into 2, 2000 rupees he has to pay at the time of making the application. If all the 1000 shares are allotted to him, next at the stage he has to pay the allotment money of 2 rupees. So again he has to pay 2000 rupees, that is 1000 shares into 2 rupees as allotment money. Next, after 1 year or 6 months or when the need arises, the company will make the intimation to the shareholders to make the first call. The first call, if the amount is 2 rupees, again they have to pay 2 rupees. This is called as amount to be paid at future dates or called as calls. A company's share capital is also referred to as paid up capital. That is, paid up capital means number of shares issued by the company divided by the amount that the directors require as payment of shares. The amount not required for the payment is referred to as uncalled amount. That is, when the intimation is given by the company to the shareholders, they have to make the payment. Okay, if the amount, for example, 10 rupees is a face value, 2 is already got as application money, 2 rupees is already got as allotment money. Now they are making the intimation for collecting 2 rupees as first call. So totally, if 2 rupees is paid by all the shareholders, the 6 rupees application money 2, allotment money 2, and the first call money 2. So the total 6 rupees is called as called capital and the called amount, and the remaining 4 rupees, that is 2 rupees for second call and 2 rupees for third call, which is not called or intimated by the company to the shareholders, that amount is said to be uncalled amount. Here the same an example is given for the same. Classes of shares. The shares are classified into ordinary shares, preference shares, deferred or founder shares. Ordinary shares means it is a basic type of shares. Full voting rights are given for the ordinary shareholders and right to receive dividends. Here, equity shares are called as ordinary shares. Equity shareholders are the owners of the company. They have full rights for voting and they have the right to receive dividend. Preference shares. Preferential rights to a fixed rate of dividends before dividends to ordinary shareholders are declared. So, when a company earns a profit and if the company has issued a debentures, they have to first declare the profit as interest to the debenture holders. After making the payment to the debenture holders, the first preference is given from the preference shareholders. Here, at the time of issue itself, the percentage of dividend will be fixed. 8% preference shares, 10% preference shares. So 10% of the profit will be declared as a dividend. Repayment of capital when company is wound up. So here when a company is going to wind up, at the time here the repayment will be made by the company to the preference shareholders. Participation in surplus assets and profits. Cumulative and non-cumulative different dividends. Voting rights, priority of payment of capital and dividends are given to preference shareholders. The last type of share is deferred or founder share, issued to initial subscribers. That means at the time of formation of a company, those who are the founders of the company will be given the founder shares. Dividends usually paid after being paid to other shareholders. So, the dividends will be paid to the founder shareholders also after making the payment to preference shareholders, debenture holders and equity shareholders. Founders are shareholders who start up the company before shares are issued to the public. Provider, establishment cost and the issue the prospectus. Thank you.